These companies really need to focus on what potentially could happen beyond the next 2.5, 3 years. The new administration comes in and the rules change completely. So you can't turn a blind eye to EVs.
Hi, everyone. Welcome to WSJ's Take on the Week. I'm Gunjan Banerji.
And I'm Telis Demos.
Telis, the big thing I've been watching this week is perps, crypto perpetual futures.
Perps, not like criminals. Perps. Not that kind of perp. Perpetual futures.
Perpetual futures.
All right, you got to catch me up.
You know, if crypto, buying and selling Bitcoin, Ethereum is not volatile enough for you, these are a way to amp up the risk even more. They're basically turbocharged bets on Bitcoin. 10x returns, 20x returns.
Over what time period? Like a day?
It can, yes, exactly.
You could make 10x in a day.
You can.
Doing this.
You can. So basically,
Who needs a casino? Really?
Well, I think that's the big thing, right? Is these have entered the U.S. market for the first time this year.
Okay.
And I think mainstream brokerages are going to look to amp up the risk even more. Like, these have been really popular bets abroad. Around 70% of Bitcoin trading volumes occurred in perpetual futures this year.
Wow.
So they are, one of the most popular trades on the planet, definitely the most popular way to bet on Bitcoin.
I know that, say, Bitcoin, again, has been trading like gold. People see it as an alternative to the U.S. dollar as a way to protect themselves from inflation. Right? That's one view of Bitcoin. I'm sure there are many. Economic data can drive that, right? Something that you see as an inflationary piece of news, maybe that drives up the price of Bitcoin. So are people trading around like data releases? Is there a certain time or pattern into when people are putting on 20x bets? I've got 30 minutes to see this thing through.
I think it's speculation. It's truly speculation. A lot of it is gambling, right? Of course, there's professional traders doing this to maybe hedge, but there's also retail traders. Coinbase brought them to the U.S. for the first time. Robinhood introduced its European clients to perps recently. So I think you're going to see these expand, and I think you're going to see leverage increase here. And you might see more of your friends or coworkers trading these things because brokerages are likely going to expand access here.
Well, to the extent that any of those folks are data-driven, there's a big piece of data upcoming this week that they could tune into, and that is the September jobs report. The last few jobs reports obviously have been fireworksy, not just the reports themselves, but the revisions to past reports. So perhaps that's what people will be most focused on. What are the revisions? I will say that the Chicago Fed, led by our erstwhile guest, Austin Goolsbee, the Chicago Fed president, they've launched a new series of indicators that are meant to study what is known about the job market and predict the future moves. And what their current forecast for the September report is that the unemployment rate will be unchanged at 4.3%. But the unemployment rate isn't really the whole story with the job market these days.
What do you think is the whole story?
What a lot of our colleagues in the journal have been writing in our recent economics coverage is that the percentage-based measures of the job market, that is not the number of jobs created or lost from month to month, but the percentage-based numbers, like the unemployment rate, might be impacted by immigration policy. If a lot of people are leaving the country, if we are shrinking the supply of workers in the U.S., that means that even if the U.S. economy isn't creating a lot of jobs, maybe even it's losing jobs, you could still see the unemployment rate looking healthy.
I thought Powell made a really interesting point about this in the last Fed meeting, where he pointed to kind of this curious balance, right?
Yes.
You're seeing
It's exactly the words he used, yeah.
Yeah, you're seeing supply down and you're seeing demand down. So it seems like we're at a fragile moment in terms of employment.
And I think it's going to raise very interesting questions about what is a recessionary indicator and what isn't.
Tell us, you follow what's going on with credit cards and spending pretty closely. What are we seeing there?
You still haven't seen a huge change in the way people are using their credit cards. Things that measure how indebted people are, the percentage of their credit lines they're utilizing, the average household debt, the average credit card debt per household. Those things haven't moved anywhere close to what we would think of as like really scary territory. And I'm talking like pre-2008 financial crisis type stuff. You see pockets of people who aren't paying off their debts at the same pace that they were before. There have been times when the percentage of people making the minimum payment has risen. But I don't think that we really see a huge drop off in credit card spending.
And what about auto loans? People still paying those off?
There are some flashing red lights in the auto market. There have been some troubles for what I think people in the industry would call like deep subprime auto lenders. That is, people
riskiest
who,
things,
the
right?
absolute riskiest
Right.
borrowers. Some people think of that as a canary in the coal mine. Wow. Could this kind of filter up to the bigger part of the market?
Yeah.
Other people look at that and say, look, it's the deep subprime part of the market. Like, as somebody once said to me, and I say this all the time, people in that credit bucket are always living in a recession. They're at risk of losing their job. They're not making a lot of money. They're struggling to borrow. You know, that's just what life is like, unfortunately. I think the big thing really happening in the auto market right now is something that's been a bedrock of the industry for a long time, which is the end of the $7,500 tax credit that you get for purchasing an electric vehicle. That is set to expire now at the end of September, on September 30th.
That was a big reason my parents got an electric vehicle, that's for sure.
And it's been a big reason people have been buying electric vehicles lately. Just consider these numbers, right? The average transaction price for a new EV was a little over $55,000. That's a Kelley Blue Book number that our colleagues at Barron's wrote about. Consumers using the credit, though, would have paid around $48,000. Oh, a big discount, right? The average transaction price for all new cars, so that would include your internal combustion engine or ICE vehicles, you know, traditional regular car, that would have been around $48,000. So basically, without the credit, EVs are going to be more expensive.
Oh, wow.
And so to help us kind of find a point on the horizon to focus on, we spoke with John Murphy. He was a longtime stock analyst covering the automotive sector for Bank of America. He recently took on a new role at Haig Partners, and he'll be advising dealers and other companies in the auto space on consolidation and other big trends happening in the market. And we had a really interesting conversation earlier this week about the end of the EV tax credit and what a future might look like for automakers.
I'm excited for this one.
It's a great conversation, and we're going to play it right after the break. All right, welcome back. We're here with John Murphy. He is a managing director in strategic advisory at Haig Partners. John, welcome to the show.
Thanks for having me. Looking forward to it.
We're on the cusp of some big changes in the auto market. There's a lot going on, and there's one in particular that I want to start with. We are now basically in the final days of the $7,500 tax credit that has gone to electric vehicle purchases. And that's been a big support for the market for a long time. And as my Wall Street Journal colleagues recently put it, the Trump administration is basically in the process of dismantling tailpipe emissions and fuel economy rules that long underpin the production and sale of the vehicles. So even beyond the tax credits there. How big of a deal is the end of the $7,500 tax credit?
It's a very big deal in many ways. First and foremost, when we look at EV penetration, last year was about 8%. First few months of this year, it's kind of ramped up because people were anticipating the end of these EV credits. But the reality is once that drops off, we're probably going to see something far below 10%, 8%, and probably just a few percent. Because for a lot of folks in the country, it's a subpar product at a higher price. Simply over time, if you can bring the cost of an EV down and ramp up the charging network and create a better product at a better price, I think people will move in that direction. But we have not gotten there yet in the auto industry in the United States, and we are probably a very long way off from actually making that work.
And so what does that mean for the pipeline of products coming out of automakers? I mean, I think we're used to seeing EVs as some of the most anticipated launches of new cars and things like that. EV-focused companies like Tesla have been big winners. But even when looking at, the big traditional automakers, your Fords and General Motors, their EV prospects were really central. How do we think about them in a world in which the EV maybe isn't seen as the growth engine as much?
So it's a great question because it's turned the industry on its head. Because for the last few years, there was such a heavy push towards investing in EV technology and product development dollars or PD dollars being spent on EVs. What we're seeing now is the front end of the curve of cancellation of some of these major programs. Ford's three-row EV that they canceled last year was a $2 billion charge. We're going to see a lot more of those coming. So what it's done is it's really created a lot of wasted capital, to be honest, a lot of head scratching as to how to handle an eventuality that's going to have a significant penetration of EVs over time. But holistically, what's happened is you traditionally have about 45 new models that are launched each year, roughly, right? This year, we're going to see less than 30 Next year, maybe we're getting back to 35 to 40. So there's a real hole in what's coming to market. And, that could put some real pressure on demand and pricing because it's those brand new vehicles that bring people into showrooms. So you got to get people really confident and excited about that new product.
What does the EV business look like without this tax credit? I mean, it doesn't go away, but how does it change it?
We used to have a market that was, call it a 16 to 17 million unit U.S. market that had a consistent powertrain. Now we have multiple powertrains, ICE, regular hybrid, plug-in hybrid, and EVs. So now you have an extreme fragmentation of the most expensive part of the vehicle, and that's going to put pressure on profits and returns over time unless you can drive significant scale. But you can't drive the same kind of scale because now we're chopping up the market into 4 separate powertrains. That's going to be a real challenge over time, and it's something that we all need to really think about in the pricing side, meaning that automakers are going to have to continue to push pricing a little bit higher to pay for this, which then puts even more pressure on the affordability issue because it makes vehicles more expensive and makes, the question of affordable transportation, which is a pillar of the economy, which often gets overlooked, that much tougher to solve.
The Journal recently tabbed up, estimates of losses from tariffs for global automakers at like $12 billion. But, if these same companies some of them are going to be dialing back in EVs, right? I mean, here's just one number, for example, from a recent story. Ford says it will save $1.5 billion on emissions credits that it uses to offset other vehicles that it makes that it won't have to be doing anymore. Is there a financial upside to some of these businesses from what's going on?
As you look at this, that number from Ford is a point estimate on savings, not necessarily also including the potential higher sales you may have on some of these larger ICE vehicles that they make tremendous amounts of money on. The F-Series, including the 250 and 350, is almost the entire profit pool at Ford. So if they can sell more of those and make more money in the near term, yes, it's a huge boost potentially to profit. There's other things that are going on in the regulatory environment, the tax environment that really needs to be taken into account. But these companies really need to focus on what potentially could happen beyond the next 2.5, 3 years. The new administration comes in and the rules change completely. So you can't turn a blind eye to EVs. So you have to think about really leveraging your core business, and that's in trucks. It's building up that capital on your balance sheet to deal with the uncertainty of all of these regulatory environments, the eventuality of some autonomous vehicles and the eventuality of Chinese competition, so that you're in a really stalwart position on your balance sheet and your capital structure to invest and deal with these uncertainties going forward.
We read a lot about Chinese automakers like BYD, right? They're growing fast in Europe, the Middle East, Mexico, Latin America. Will investors be excited about a company that has mastered the U.S. market and makes vehicles for the U.S. market, but isn't necessarily in the global conversation? Would investors want a business like that?
I've been involved in the auto industry for almost 30 years, and a very significant rule that's existed for decades is the only place that automakers really make significant amounts of money is in the North American truck business and global luxury. So when you look at what's going on with the Chinese manufacturers, it's maybe making sort of the global mass market that much tougher and potentially worse to be invested in. But it is not a place where you've ever really made any money. And over time, you've probably lost a tremendous amount of money. So I think that what's going on right now is everybody needs to be even more diligent about where they're making money, which they've not had the greatest discipline historically, but it's mission critical that they do it now and recognize that the D3 are North American truck businesses that potentially have an opportunity.
The D3, the Detroit three Detroit
GM,
automakers.
Ford, and Stellantis. So they have potentially this real opportunity to leverage that, transition, and really build their luxury brands because they have some really good product that could compete not just in the U.S. but globally, and recognize they were never making much money, if any at all, in the mass market, and now the Chinese are coming in and making it that much worse. But what you have to recognize is that you can have a smaller company that is more profitable, but not only do they have to love the internal combustion engine vehicles, they need to love their customers and their business partners on the dealership side, because that is where there's this huge profit pool that for some reason just doesn't really get recognized. I mean, I would estimate that GM and Ford on an ongoing basis are doing about 20% of their operating profit or EBIT in aftermarket parts. Investors don't know that. Right. I mean, they don't recognize that. The companies don't talk about it in a segmentation basis, but that is a huge opportunity for them to massively increase their profitability because they are not playing in the life cycle of the vehicle much beyond the first 3 years. And even in the first 3 years, their dealers and the automakers are penetrating less than half of the potential parts and service revenue and profit.
Looking from the stock market's point of view, it seems like investors maybe are already kind of thinking along those lines, right? You've got some surprising performance this year. GM is up 11% as of this recording. Ford is up 17%. I mean, Volkswagen is up 12%. Tesla has rallied back a little bit. It's now up 8% for the year, but it was down as much as 15%, just a few weeks ago. And for perspective, the S&P 500 is only up 13%. So automakers are more in tune with this kind of bull market. Do you think that's what investors might be thinking about? Is like through all of the mess of what's going on right now, right? You have big changes. You have tariffs. You have changes in incentives in EVs. And are they looking at those domestic automakers and saying, boy, there's actually the potential for a refocus on like the core profitable business?
I think there's an increasing understanding that that's where they're making the money. The companies are focusing on that, but I also think what they're finding is they are having very good discipline on production and matching supply with demand, which is resulting in pricing that is remaining far more resilient than anybody has been expecting.
Pricing, you mean the prices they charge to consumers?
The pricing they're charging to consumers because they're keeping a relative lid on supply. Their dealers have inventory that are closer to normal, right? So they're not super short, but they're not getting into excess positions, which means the consumer wants a vehicle and they want a certain vehicle. They're going to have to pay what is, the market price, which is a price that is good for profits through the value chain. It's good for the automakers. It's good for the dealers. And ultimately, in an odd way, it's reasonably good for the consumer because their trade-in value or the residual value is holding up. So the equity in their vehicle is actually stronger. So when they go to buy a new vehicle, they're in a better position. So managing pricing through the age spectrum of a vehicle actually can be a good guy or a good factor for everybody that's involved.
Yet General Motors said something interesting. GM said that it expects consistent pricing to offset about 10% of its tariff costs this year. Is that what you're talking about?
That's definitely what I'm talking about. And this is something we've all been, kind of pushing the automakers to really, really focus on. And it really took COVID and the supply chain shock after it to really kind of force this experiment upon the industry where you're short of supply of parts. So you have to make the product that is sort of the high-line product, the high-trim product, and focus on keeping price high. And they were forced into this experiment. It's getting a little bit wonky. There's something called the Lagrangian profit maximization equation. Okay. It simply means if you take your marginal price down, you might drive a lot more units and your total profit might go up. The problem in the auto industry, if you look at that sort of at first blush, is you end up killing your pricing and it hurts your residual values, which then eventually comes back and whipsaws. And then all of a sudden your new vehicle pricing is getting hit even worse and you're caught in kind of this death spiral on pricing. And now what you're seeing is a more stable environment in pricing, which once again is good for the automakers and their profits, but is actually not too bad for the consumer on a holistic basis.
A lot of investors have been shifting their focus globally. And so as people do that, as they think maybe more globally in their portfolio, and they're thinking about, the end of sort of EV credits here in the U.S., do you think it makes sense for people to start thinking about, maybe I want to move some of my money into kind of global automakers because, maybe they are focused on that mass market global EV market. And I really still think that's the future. As an investor, how do you think they should think about, U.S. automakers versus global ones? What's the right way to go about that?
I think what is going on right now is something akin to what we saw in the 20s, 30s, and 40s here in the United States, but it's happening on a global basis. So I remember a long time ago being the Walter P. Chrysler Museum, and there was this great chart of dozens of U.S. companies and how over time they consolidated down to largely the D3 and then some of the now the imports. What you're looking at is something very similar on a global basis right now. Is you kind of look at China and you have over 100 automakers, and you're like, okay, let's start the list and figure out how that's going to consolidate over time. But that's not limited to the Chinese market because these companies are global. So every incumbent has to understand that they are in this new pool that is going to consolidate over time. And it's foolish to think because you're just in the U.S. or you're domiciled in the U.S. or domiciled in Europe or you're domiciled in Korea or domiciled in Japan that you're not going to have to deal with that consolidation as well. The thing to also remember is that governments do get involved in committing capital to this industry. And as an investor, that kind of makes it challenging because you have all these fundamental factors to think about, but then you kind of have these incentives and regulatory, issues that, that are set up to favor the home team in some ways. So it's a really challenging way to make money. I do think there's probably going to be some really big winners. There's probably a lot of money to be made in the global automaker side. Suppliers, I think, are very interesting. And I think the dealers are probably the easiest way and most reliable way to make money as an investor. There's public stocks right now, but mostly it's private. And if you were to look through the value chain, the consistency of earnings and returns over time, you can bet on all these, these big players and who's going to win or lose there, which is very interesting and intellectually challenging and a lot of fun as an analyst to look at. Or you can get sort of to somewhat the more simpler interface with the consumer where there's a lot of money that can be made over time as well. So I think there's probably bigger opportunity in the suppliers and the dealers that are risk adjusted, better investments. But there's a lot of stuff and a lot to work on the automaker side as well.
So even if you're still a domestic focused investor, you're saying you're not necessarily being left out of this kind of this next 100 years of how the auto industry will evolve.
Absolutely not. To really make it simple, if you're a dealer that owns 1 or 2 stores in the United States and you're running a really good business, you not only need to understand what's going on in your market and with your automaker customers, but you also really need to zoom out and understand what's happening on a global basis because that global competition is impacting the automakers that you're selling vehicles for. So everybody needs to be fully aware about this, whether you're making a very small local investment or you're making a global investment. The industry is just a global industry right now, and there's no way to bifurcate it. There's differences between markets, powertrains, and all that, but it's a global. You're making a global investment.
Interesting. All right. We're going to take a quick break, and when we come back, one last question for John Murphy of Haig Partners. Welcome back. We've got one last big question for John Murphy of Haig Partners. John, with the $7,500 EV tax credit coming to an end at the end of September, are we going to see a renaissance for the internal combustion engine? Is that going to be the vehicle of the future, or is this just a speed bump on the long road to EV dominance?
So I might use a different period in history and call it the Ice Age cometh, right? So the internal combustion engine cometh. Because yes, I do think—
Cometh back.
Yeah, it cometh back. Yeah. I think for the next few years, next 3 years at least, we're going to shift back in that direction in a significant way. And I think what you're going to see over time is a more measured and rational approach by automakers to help solve the environmental issues the auto industry is involved in some cases causes. And we're going to see the hybridization of powertrain, which is something that is much more palatable to the consumer in the United States. And if you were to look at some products like a Toyota Camry that gets 52 miles per gallon because it's just a hybrid, very rational, inexpensive vehicle relative to others, that's great transportation. But I think you're going to see that in the large trucks at GM and Ford and Stellantis, and you're going to solve the problem in a more practical way. Toyota's got a very interesting stat. It's called the 1-6-90 rule. So the 1-6-90 rule is for all the precious metals and everything else that needs to go into an EV, they can make 6 plug-in hybrids, or they can make 90 regular parallel, hybrids like a Prius or like what I just mentioned in the Camry. Those 90 hybrids save 43 times the CO2 as the one EV. So it's 90 cars versus one for sure. So it's not necessarily a super fair comparison, but it shows that if you do something that is more practical, that the consumer will accept holistically, they don't have to change their driving patterns or their life. You can actually have a huge impact on the environment in a way that's as opposed to sort of this revolution that EVs have been set up to really be. And the consumer's just not ready for it.
Interesting. Well, John Murphy, thanks for joining us.
Thanks so much for having me. It's been a blast.
There was like a business where like people who left New York or moved away, it's like you could order like Brooklyn, you could order dirt from New York to your house, and like your kids could play in
something
it.
Like that. Yeah. I vaguely recall something like that.
Yeah. So to this day, I say anytime somebody gets dirt, I say people pay good money for that dirt.
Yep, they do.